All right, guys, now I'm gonna just jump into a quick Q&A with one of my friends who's gonna just ask me some questions about how we got this deal done and more details about the nuances of the deal. So if you wanna stick around for that, please join us. It's two apartment buildings that are owned by the same seller nearby each other. My team found the deal. I have a vice president of acquisitions. What they do is they comb through the country of 1,200 to 1,500 deals a year to find 4 to 6 that work. We go through a process to where they come into our pipeline, we look at them, we understand them, underwrite them, and then if they pass all the different levels of scrutiny, they get to the final end, and then they call me, and then I'm able to go high level and look at it and see if it makes sense. And then we visit the actual property. At that point, I make a decision. Are we in? Are we out? And if we're in, we go all in and we fire up the engines. There's a lot of big deals that we don't pursue, but this deal happened to be a big deal in our backyard that we know well. We own assets all across the country, but Atlanta is our home base, and this is where we have an unfair advantage. So we knew Atlanta. 2, we already own a property relatively nearby, so it made sense to add to our portfolio there. And number 3, we have a strong relationship with this broker, and it made sense to then consolidate that relationship. And number 4 is it allowed us to do 2 deals at once, which is challenging, but it's also helping us grow faster. The biggest deal we had done before this was a $76 million deal. $50 million deal. $30 million. We've looked into bigger deals, but the amount of money needed to pull that off is just so staggering still at this point. That doesn't make sense. And also, there's a sweet spot. Like if you try to buy too big a deal, it's like buying a city. It's even very difficult to manage and take over. And if you buy too small, you're not gonna have enough economies of scale. So there's a sweet spot between, I would say 200 to 400 units is the right amount of deal to buy at any one time. So we've had 2 huge institutional groups. One wrote like a $5 or $7 million check, another one wrote a $10 million check. And then we've had probably between the 2 deals, maybe 250 individual investors investing in the deal. Let's say 150K. We had to raise $50 million for this deal. And so 15 million is from these big institutions that they wrote checks for us. So the 35 million, if you want to divide 35 million by like 250, it'll tell you the average investment check. These are doctors, these are lawyers, these are accountants, these are business owners, these are engineers, these are people who've sold their tech companies. This is software engineers investing in these kind of things. They're normal people who are credit investors, so meaning they make 200 as a single person or 300 as a couple, and they're realizing that the stock market's not the only way to get wealthy, and if they want to earn real wealth, they need to diversify. So we've been doing this 8 years, and so we've built up an investor base because we provided good service, good returns, and good exits for our investors, and so they've reinvested with us. Number 2, we do something called a 506(c). It's a SEC, Securities and Exchange Commission designation that allows us to raise capital through public forums, including social media. No, 50 million is the equity. To buy it, you need 100 million. You got a loan for 50 million. Normally, in better times, you can get a loan for 75 million. But in these tough times, we had to bring much more cash to the deal than we normally would have. See, when we bought the $76 million deal, I only brought $18 million of cash. Now I have to bring 50 million. It's just mind-boggling. Our network of people, plus we do webinars and we do ads and bring people in. So 35 million from investors and 15 million from these big institutions that joined us. So we make money because to put something like this together is very complex. It takes expertise, it takes leadership, it takes relationships, and it takes experience. And so typically in multifamily deals, if we're doing this kind of syndication model, you can charge fees and things like that. And so we have fees to allow us to recoup some of our cost and some of our investment. And then the second way we make money is we are partners. We are the general partners and we work with our investors who are limited partners. So normally they are about about 70% of the profits and the cash flow, and we are 30% of the profits and cash flow. So this is how it works. Yes, because each deal leads a certain kind of income, but the more deals you do, then you can take care of your overhead, and everything rest is just for us to take home. The amount of time it took us to do these two, we could have probably done 4 small deals. To do this deal, we brought in so many different investment people to help cover the 50 million that those people you have to pay, versus normally when we raise by just for ourselves, for our people, and we don't have to pay anybody. So when you're bringing people in, you pay them to bring their money in. So you're giving up some of your upside.